Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
You've heard it before. I'll say it again. You have to plan for a rainy day. But when it comes to your retirement, do you feel like it's going to rain every single day? That sunshine is nowhere to be found. Stick around over the next half an hour. We will show you the sunshine to help you protect your nest egg when it comes to retirement. Welcome to the show, everyone. Your Money, Your Wealth is the television show you're watching. My name's Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. I am with the big man, of course, Big Al Clopine. He's sitting right over there. He's going to join us momentarily to break down the agenda because there's some issues that we are having when it comes to protecting our nest egg. When it comes to retirement, some things that you have to consider to make sure that you will find that sunshine when it comes to your retirement. That is the financial focus today, folks. All right, let's look at this real quick. Crazy statistics out there. You got age groups, millennials, you got the baby boomers, you got Generation X. I mean, millennials, almost half of them have not saved a dime. Half. Then you look at Generation X and baby boomers, so that's a little bit older generation, right? Half of them have less than $10,000 saved. You cannot retire on $10,000. Let me just tell you that. I've been doing this close to 20 years. It is almost impossible to retire on $10,000. Have a good couple of months. That's it. Let's talk about what you need to do to prepare yourself for this rainy day. And this rainy day could happen every single day in regards to your retirement. Let's bring in the big man, Big Al Clopine, to help us break it down. It's raining. It's El Nino, Alan, when it comes to retirement.
When it comes to retirement, that's right. There is a lot of El Ninos out there in terms of rain, and there's a lot of things that you need to do to protect your nest egg.
Yeah,
really.
most definitely. You got to control the things you can't control, right?
Well, I think that's right, Joe, and I think that probably starts with saving, right? And that's one thing you can control, is how much you're saving. And so we're going to go through 6 different things that you can do to protect your nest egg. And the first one really is building your savings while you're working. That's got to be number one, and we're going to go through some strategies there. Number 2, for many of you, it might be working a little bit longer because we're living longer, so you might need to work a little bit longer. And then how about having a good income plan? So you've saved this money, you worked a little bit longer, you got good Social Security benefits, maybe a pension. How do you create the rest of your income from your portfolio? And then your income plan, well, that falls apart if you don't have the right investments. You got to be somewhat defensive, but not completely defensive. You got to have some growth as well. You've got to make sure you got adequate insurance, and then the final safety net, if you will, would be home equity. And if you've got a home and maybe you're retired, maybe the mortgage is paid off, then you've got that to fall back on if you need to. So, Joe, it's one of those things where we sometimes can have a plan for retirement, but things come up, you know, whether it's divorce or job loss or medical issues,
right.
And it's like making sure that you've got some rainy day funds for those events.
Well, I mean, if you look at retirement, right, you need capital to maintain your lifestyle for the rest of your life. So how are you going to do that? Let's take a look at a couple of different examples. I know it's always easy to go back in time, and I wish I would have saved a little bit more. But for those of you that are watching that are younger, hey, take a look at saving some money here. $400 a month, right, Al?
Yeah, so a 30-year-old retiring at age 65, let's say you can save $400 a month, and so that's instead of making a car payment.
So you walk.
Right? You walk. You ride your bike.
You walk everywhere.
You ride your bike,
save $400 a month.
But look at that, $720,000 that you've got saved. And then if you can save full into your retirement plan, which is about $1,500 a month, it's about $2.7 million that you accrue. So that's great if you're 30. But, Joe, what about if you're already 50 and you don't really have anything saved?
Right. I mean, this is the key component here, is that sometimes people feel helpless. It's like, oh, my gosh, I'm running 50, 60 years old. I don't have anything saved at all. All right, well, let's just take a look. 50 years old, when you're in your 50s, you're in your peak earning years. If you can save, sock away $800 a month. maybe instead of Big Al's, instead of 2 car payments, both of you and your spouse walk. Take the bus.
Yeah, you do take the bus.
But I mean, here's just a simple example. $800 at 7%, that's $300 grand. If you can max out your overall retirement account, now it's time to get serious, right? You're in your 50s. You want to get serious when it comes to saving money. So if you can max out your retirement accounts, now you have something here. All you need is a little bit of time, okay, and a diversified portfolio, of course, to get that 7%. But it's not as daunting as it seems. $400 a month, $600 a month, $800 a month. Okay, yeah, that's a lot of money. But if you put it into a 401k plan, you get a tax deduction. It's not nearly going to feel like $800, Al. When people take a look at what they really want to accomplish long term, they could put things through the asset test, and that's what we're trying to help you with. Take a look at what you're trying to do, get a plan in place, and make sure that you execute that plan. That's key.
Well, that is true, Joe, and so for some people, it's going to be working a little bit longer, right? And I think people sometimes are surprised how much difference that can actually make in terms of your overall savings and income. And we've got an example of somebody that makes about $100,000 a year. They got $500,000 saved. And if they can keep working and saving about $10,000 a year into their 401k, let's first of all start at age 62. That person retires, they make about $50,000 a year in their fixed income. But what if they work part-time just from 62 to 66? That number grows to almost $67,000. Had they worked full-time to age 66, it's almost $70,000. Now look at this, working part-time to age 70, $72,000. And then look at the very bottom. If you keep working all the way to age 70, full-time, $93,000, Joe, it's almost double the income. And sometimes working just a few years, it doesn't necessarily have to be 8 years or more, but sometimes just a few years can make a big difference.
I mean, that's one of the most important slides I think we've shown in this show, is that because now people still want to retire at 62. I'm telling you, for a lot of you, it's just not feasible. Wait until 70, and trust me, right, with the advancements of medical, the 70 is the new 50, right? Don't worry about it. You don't have to like live your parents' retirement saying, oh, I'm 62, I'm not retired yet, I don't have enough money. Just push it out a couple of years can double your income. It is significant if you put a plan in place and give yourself a little bit more time and get a little bit more discipline on what you're doing. Great things can happen. Great things can happen.
Well, they can. And so by working just a little bit longer, what happens is you end up delaying your Social Security benefits, so you get more income there. You're saving longer, right, because you're working longer and you're not tapping into your nest egg, so it gets to grow that much longer.
Yeah, and you die sooner, too.
Well, you get less years, but you know what?
Right.
I would argue that by working and having purpose, you're actually
going to live to about 100.
Live a longer life anyway,
okay.
Right?
All right, hey, we got to take a break. Don't go anywhere. We got a lot more to discuss when we get back. We're talking about a rainy day, how to prepare yourself for a rainy day. And we are going to get to true false. We're going to get through all sorts of stuff, so don't go anywhere. Good morning, San Diego. We'll see you in a bit. Hey, welcome back to the show. Show's called Your Money, Your Wealth. My name's Joe Anderson with Big Al Clopine. Thanks for tuning in. Talking about protecting yourself, protecting your nest egg when it comes to a rainy day. But guess what? When it comes to retirement, it's raining every day for a lot of you. So what can you do to get prepared? That's what we're talking about today. Before we dive into the meat, let's go to the true false. Let's see how you did.
It's best to temporarily stop contributing to your retirement plan to pay for your kids' college. True or false? And I would say in most cases false would probably be the right answer there. And mainly it's because if you pay for your kids' education with money that would otherwise go to your retirement account, you're jeopardizing your own retirement. College can be actually, you can get college loans that can be funded. Maybe your child should consider going to maybe junior college a couple years instead of incurring all this expense. You don't really want to jeopardize your own retirement. And I might say this too, my generation, the baby boomers, has tended to try to finance their kids' college. And I think now we've realized perhaps it might be better for your own child to at least do some of of it. Don't jeopardize your own retirement is what I would say.
Yeah, I saved for my college. You know, you take a look, you get in, I mean, student loan debt is crazy. So let's just, that's a different topic, a different show. But if you're jeopardizing your retirement to help the kids' college, yeah, I get you want to help the kids. But let's say that now the child gets out of school, he has a student loan, he has 40 years to pay it off. You do not have 40 years. I mean, you should be saving for 40 years for your retirement. So there are two different things, two different topics. We could have a whole show on that.
Well, we could, Joe. And so at this part of the show is the time where we have a client ask you a question. It's and you've got 60 seconds to answer it. And I might say it's a question that Joe Anderson has not seen. So this is completely at cold. Let's see how he does.
What, so every other time it's been hot?
Yes.
I'm 49 years old, and I'd like to know how much I should be putting in my Roth IRA every year so that I could retire comfortably around the age of 65.
49 years old, she wants to retire at 65. How much money should she put into a Roth IRA? Well, it depends. $6,500 is the maximum. Once you hit 50, you're 49, so that number's $5,500. But there's AGI limitations to the Roth IRA. So when you take a look, you have to look at the bottom of your 1040. Now, if that's more than $131,000 if you are single, or $132,000 for 2016, or if it's more than $194,000, you cannot contribute to a Roth IRA. You make too much money. So then you would have to go maybe a traditional IRA or a 401k. So you have to look at a couple of different sources. If you save the maximum at 50 to 65, $5,500, you're going to have maybe $125,000 in retirement. That's not going to be enough to get you through. So you have to do some more savings. Go with the 401k, match, then Roth. Boom.
Not bad, Joe. Not bad at all, especially for not knowing the question. And that's there's really a lot to that. I mean, you got to figure out how much that you want to spend and what your income sources are. And that is a perfect lead-in to our next topic here, which is how to create a good income plan from your resources that you have. So I want to go through an example. If you think about your retirement and you decide you want to spend $75,000 in retirement, and then you look at your fixed income sources, that would be Social Security, maybe pension, in this example, $50,000. Calculate that shortfall, subtract one from the other. You need $25,000 from your investments. And then you got to add up your liquid investments, your retirement accounts, your non-retirement accounts, and so forth, $700,000. And then you do that little division, divide how much you need, $25,000 into the $700,000. In this case, you get a 3.6% distribution rate. So you're going, what the heck is that? That's kind of a measurement of the health of your retirement plan. So I would say this, as a general rule, you want to keep under 4%, but that's a very general rule. Some of you may need to keep under 3%. Some of you could be a little bit higher, but that's a good starting point. If you do this calculation right now and you see that you have a 5 or 6 or 7% distribution rate, you got to go back to the drawing board. You may need to work a little bit longer, or you may need to reduce your spending. You may need to downsize your home. There may be a number of things, but that's kind of the first step, is look at that income plan. And Joe, really, it's a little deeper than that. It's also considering the taxation of your income sources.
Right, I think that's one of the most important when you take a look at, once you've accumulated the wealth, right? So now it's time to take the income from the overall portfolio. And I would say most of you that is watching this show is that a lot of your money is in a retirement account, a tax-deferred account, a 401k, an IRA, 403b, TSP, 457, whatever. All of those dollars are going to be taxed at ordinary income. So if you look at the bottom right-hand corner there, it says pre-tax in, tax-deferred. It's 100% taxable coming out. Then you have other pools of money that you can invest in, such as a taxable pool, which is a non-qualified or just a capital investment. It could be a mutual fund, a stock, a bond, real estate. Once you sell that, if you hold it for 1 year and a day, you get a specialized treatment, tax treatment. It's called long-term capital gains. For most of us, it's 15%. It could be as high as 20 or 0, but it's in most cases lower than the ordinary income rate. Then the best pool of all is the top circle. If you want to go back to that, it's tax-free. Ideally, it would be great if all of your income would come out tax-free. But if you would look at where your assets fall in this diagram here, I would say most of you fall in the tax-deferred, where it's going to be ordinary income coming out. So this is where planning comes in. You have to decide how much money that you're spending. What is your fixed income sources, right? What is your Social Security? What is your pensions? And then where's your other assets going to come from? If it's all going to come from an ordinary income tax plan, you might push yourself up into a higher tax bracket. Alan, there's rules of thumb that people got to throw out the window, like you'll be in a lower tax bracket in retirement. That is not the case for a lot of you because you've saved most of your money in a 401k plan that is going to be taxed just like your paycheck when you pull the money out. If you want to maintain your same lifestyle, how are you going to be in a lower tax bracket?
That is right, Joe, because that is kind of the general perception that you're going to be in a lower tax bracket. And I'll tell you, our experience is that when you retire and you've saved a lot of money, you'll probably be in the same tax bracket, if not higher. Now, I want to talk about one other thing before we end the segment, and that is a good income plan and a tax plan kind of falls apart if you don't have the right investments. And so you need to be somewhat defensive in retirement, but not too defensive, because you're going to have some growth. You need some growth because you may be living 20, 30 years in retirement. So how do you stay defensive? Well, how about this? Consider the lowest risk portfolio that's going to work to accomplish your goals. We call that goals-based investing. Number two would be diversify your investments with low-cost funds. Why get into retail mutual funds that are very expensive? Have a rebalance strategy so that you're not just doing nothing, and then stick to your plan. This is really one of the most important things. Once you have a good plan, you got to stick to it, Joe.
Yeah, because if you take a look at the average investor, Alan, as soon as things get a little bit rocky, right, the average investment does a significant return, but the average investor does something significantly lower because you're buying and selling, getting in and out, searching for that magic potion when it comes to your investments. Believe me, it is not out there. You have to have a well-diversified plan that you can control certain aspects of it. Control your risk, control your fees and costs, control your taxes. If you do those things, you're going to have more confidence. With confidence brings a lot of really good things. When markets go down, you're not going to freak out. You're actually going to say, hey, there's some tactical moves I can make here, like rebalancing or tax loss harvesting. Get a plan together. You'll have more confidence and you will succeed in your overall retirement. All right, we got to take a quick break. When we get back, we're going to flip the show back to you, answer some email questions, and we got a couple of other things up our sleeve, so don't go anywhere. Show's called Your Money, Your Wealth. We'll be back in just a second. Hey, welcome back to the show. Show's called Your Money, and it's Your Wealth. Joe Anderson, Big Al Clopine hanging out. Good morning, everyone. Talking about putting your nest egg together, protecting it from a rainy day. And we'll get into everything that you need to do. We'll wrap things up here in this last segment. But before we do that, let's go to the true-false.
In comparison to your final salary, your nest egg should be twice as big. Joe, I don't know, is that enough? Twice your salary?
I don't even know what the heck that means. So what, if my salary is 50 grand, I need 100?
Yeah, that's what it's saying.
No, you probably need at least 10 times. I would say 10 times. Well, there's a couple of different studies. It depends on how much money that you're going to maintain as a lifestyle. Do you have a pension? Do you have Social Security? But I would say 8 to 10 times is probably a better figure to shoot for versus just doubling your last year's salary, because, right, maybe that will last you 2 to 4 years.
Yeah, I would agree with you, Joe, and I think Fidelity kind of came up with that number, 8 to 10 times, and that was based upon you spending about 80% of your pre-retirement spending, so with Social Security benefits and so forth. So a lot of folks that we see that are baby boomers that are retiring are actually wanting to spend more because they're traveling. So it could be 15 times. I mean, it really is very individualized. But 2 times, that's false. You need more than that.
Right, and so here's what we have to do, right? So we talked about this throughout the show, is that you have to accumulate more money. You have to start saving a little bit more. Take a look at what you're saving right now. How much more do you have to save to maintain the lifestyle? A lot of you are going to have to work a little bit longer, all right? So maybe age 70 is the new 50. Embrace it. Work a little bit longer. A lot of good things can happen potentially when your Social Security goes up. You have more savings and so on and so forth. Then you have to have an income plan. You got to figure out what you're trying to spend, what's going to come in as fixed income, such as Social Security, pensions, and the like. How much are you short? That's going to tell you how much that you need. You need a tax plan, and you need a properly diversified investment strategy. But now you have all that. You think you're done? No, not yet. You have to protect it all. You have to protect it when it comes to risk management. Look at at some insurances here. So when it comes to home insurance, car insurance, that's one thing. Life insurance. What about long-term care? There's a good possibility that you or your spouse might need some sort of care. And then you look at health insurance. Where do you think health insurance is going up? And then, of course, Big Al, you got the good old property casualty. You want to wrap this thing up and have an ironclad financial plan, and risk management is a key thing, because if one spouse passes, what is that going to look like? If one spouse gets injured, gets sick, needs help, a lot of that costs a lot of money. And so you want to make sure that you are prepared. All right, let's flip the show back to you. A lot of great email questions this week, big man. Let's start with number 1. What do you think?
This is Sid in Leucadia. My daughter is a single mom. Can I leave more money to my daughter than my son when I pass? And Sid, I would tell you this, yeah, you can do whatever you want. It needs to be spelled out in your will or your trust. If there's no will or trust, it's going to be divided equal in accordance with, in your case, California law. But yes, you can do all kinds of things. You can have certain lump sums go to one kid and then everything else 50-50, or you can just have different kinds of splits, whatever you want to do.
Yeah, I would agree with that. So maybe the daughter needs a little bit more money. She's a single mom. So it's like, all right, well, here, you can split up your estate any way you like, but you want to make sure that you document it. Because if you don't, guess what? The state of California, if you live in California, will come up with that estate plan. It will not nearly be as effective as you want it to be. Let's go to email number 2.
And this is from Mark in Lakeside. When I retire, I will need my pension to live on. Should I take a monthly income from my pension or a lump sum? Joe, we get that question all the time. How would you answer that one?
It depends. I mean, with everything else. I would say in most cases, I think it makes more sense to take the annuity or the income stream. But the Pension Protection Act of 2006 is not protecting us. It's protecting the corporations and the companies, because there's a lot of liability, I guess, when it comes to the pension world, is that we're living a lot longer. And then let's say if you're making in a pension payment 70, 80, sometimes 90% of your income, and they have to continue to pay that out for a long period of time, right? It's putting strain on the overall pension. So that's why a lot of new employees do not have a defined benefit plan or a pension plan. But you have to run the numbers. You have to figure out a lot of different things when it comes to this. How strong is the company? How strong is the pension plan? What's your life expectancy? Can you manage the assets yourself? If you think you can beat what you would get from the pension, maybe that might make sense. You have to look at your tax situation. There's no cut and dry answer whatsoever when it comes to that. Do a little bit more planning, because once you make that decision, it is absolutely irrevocable. Let's go to the last one, Al.
Okay, here we go. We'll do this one quickly. This is from Steve in Encinitas, and he says, should I roll my 401k over to my IRA? I'm 50 years old and I plan to retire in 5 years. My funds are getting below average returns right now. I'll answer the first part, which is when you retire at 55, if it's in the 401k, you can actually pull that money out and pay tax on it, but no penalty. There's different rules for penalties. If it's in the IRA, you got to wait until you're 59 and a half, unless you do what's called a special 72T election. But Joe, what about the investments? Maybe the investments in the 401k are no good.
Yeah, but who cares? I mean, there's got to be some investments in that 401k plan. Most 401k plans have so many different options. It's probably your selection of the investments that are not necessarily doing well. Or maybe you're just looking at short-sighted over the last maybe 6 months. Maybe those investments are doing very well because the market has been fairly volatile over the past couple of years. So take a step back and figure out exactly what you're trying to accomplish. Don't blame the investments. Maybe blame the person who is picking it to get the right overall portfolio. Keep it in the 401k plan if you plan on retiring at age 55. You have full access to the money. You avoid the 10% tax penalty. So yes, that's a no-brainer in my case if you're going to retire at 55. Do not put it into the IRA. Then you would have to do this crazy 72T tax election, and that will probably blow up on you. So, don't do it. Just keep it in the 401k plan. All right, hey, stick around next week. It's Big Al's favorite topic. It's Roth IRAs. So we got to get out of here. Thanks so much for joining us this morning. Have a wonderful weekend. You just watched another phenomenal episode of Your Money, Your Wealth. Have a great weekend.